Good morning, everybody. Hey, welcome to Wednesday. It is June 15th. Hope you guys are having a great week. Hey, yesterday ended up being a mixed bag. We'll talk about that and more when Dave joins us here in just a few moments, because we got a lot of stuff to talk about today when it comes to economic news that's coming out and the possibility of a huge rate increase coming from the Fed. That's what I'm seeing across the board. We'll talk about that again more when Dave joins us here in just a few moments. Before we do that, though, let's not forget that there's a lot of things in this world that you and I cannot control, but we can control how much risk you have in your current portfolio. The problem is that most of us don't know what that is. How much do we have? How much should we have? That's why we developed our core retirement design, to help design the retirement you always dreamed of, to make sure that you don't have too much risk in your current portfolio. Give us a call at 863-382-0037 to schedule your core retirement design phone consultation. No cost, no obligation, simple and easy to connect via the phone. Again, give us a call at 863-382-0037. Hey, with that, we got Dave coming up next.
105.7 Light FM, we're trying to sort things out as to what's going on in the financial markets today because, well, topsy-turvy would be the appropriate term. It is time to check in on your money and see what's going on Wall Street today. Let's check in with Phillip Statler from Statler Financial Services downtown, who's on the phone right now. Phillip, how are you today?
Doing all right, man. It's great. Halfway through the week. And man, I wish we could just get a couple better days in the market.
And given what the Fed's likely to do today, I'm not necessarily counting on today ending up as one of those good days. Setting the table, another off day yesterday on Wall Street for the two blue chip indexes. Anyway, the Dow was down another 152 points. Standard & Poor's was off by 14, and we did eke out a little bit of a gain on the NASDAQ, but given the fact that it's down something close to 40%, well, positive 19 day doesn't sound very impressive to me, does it to you?
No, it doesn't. It's just better than going red,
Yeah.
So, yeah.
We start the day out. We got a pretty good-sized data dump here today. The retail sales, you and I were kicking around until it was almost too late because they do it three different ways. Retail sales in the country, retail excluding automobiles, and excluding automobiles and gas. The overall retail sales for the nation last month were up 0.1%, which was just about what they expected. Retail sales excluding autos and gas were expected to be 0.4% up. It was only up by 0.1%. Then they pulled just the gas out and leave the autos, and we missed on that one too. So basically big ticket stuff like tanks of gas and cars, we aren't doing all that well on, are we?
Yeah, tanks of gas. That's a big ticket item these days, isn't it?
Good Lord, it cost me $55 to fill up my little four-banger last night, and I know that sounds economy compared to the guys carrying SUVs around, isn't it?
Yeah, definitely. I saw a guy the other day, he said his F-150, it took him almost $150 to fill up.
I got a friend that drives a large truck. She says, I don't wait until it gets below about 3/4 of a tank because I can't afford to top it off anymore. Think of it as a savings account. Bottom line is we're relatively flat, some misses on retail, and it's looking at those numbers when I kind of put them together. Basically, we're starting to economize on everything in order to save money on gas because everything was pretty much about what we expected overall. But it's painfully obvious we're saving money for gas and spending a little bit less on cars and spending a little bit less on everything else, kind of the net total of those three numbers. Wouldn't you agree?
Yeah, it definitely looks that way, Dave. So retail sales, I'm gonna say overall didn't go our way, but wasn't a huge deal either side, which is okay. I mean, given the circumstances we're in. I mean, there's so much uncertainty bouncing around right now that anything within the close to the spectrum of what was predicted or expected is really kind of, I guess, good news in a way.
Hey, our standard for performance is kind of going down. Now a near miss is good enough these days because we're not expecting much. One thing that did come out first thing this morning that is kind of backhanded good news a wee little bit. We had a real tanking on the number of mortgage applications last week. That was reflective certainly to a part of the Memorial Day weekend. They were down 6.5%. They went up by 6.6% last week. However, just because we got to always show the big gray cloud outside the silver lining, that's still 2.5% below the week before that. So it's not looking all that good. And yes, people, mortgage rates up in the last week, just the last week alone, by a full 0.25% for a 30-year fixed rate mortgage, which doesn't bode well for the national figures on housing as time goes on, does it?
No, it really doesn't. And so also consider, I saw an article that said that that's 50% from where it was a year ago.
Yeah.
Mortgage app. So, yeah.
It's the serious buyers only, really, that are out there right now. And I keep saying that the beauty of living in Central Florida is we do tend to lag the trends by a little bit. Our homes are still moving fast. Our supply still is outstripped by the demand, and we're still healthy here. But that's a luxury because we're seeing the national trends, and anybody making a plan to move kind of has a delayed effect around here because you can move here and still take advantage of a boom while the nation is giving us a pretty good indication there's a flattening effect coming soon, isn't there?
Well, that's true. So, yeah, we're talking about that. Let me just share this article that I came across yesterday because I think this one really highlights it. And that's there's two real estate companies, Compass and Redfin, that big time housing market. They are laying off huge. I mean, you've got Compass is laying off 10% of their workforce. Redfin is laying off 8%. So, that's one of the things I've been kind of tracking is layoffs. And so that's just another set of layoffs. That's probably the fifth or sixth company I've seen that has announced some form of layoff, as well as I saw another one earlier that one of the car manufacturers is also laying off. They didn't say how many people, but Stellantis, which I'm not sure, but isn't that now like the Chrysler brand?
It escapes me right now, but that rings a bell.
Because they're laying off their Sterling Heights, Michigan stamping plant is where they're laying off at. They didn't say how many, but yeah.
I think that's a supplier to Chrysler at the very outset. Basically, we're starting to see some of the chinks in the employment market as well. And we've always been saying the thing that's going to stave off recession is if our employment market continues to be hot. So that leg on the stool is something we got to watch rather carefully.
Starting the big kahuna.
Yeah. Are you there?
Yep, I'm here.
Oh, okay. The big kahuna today in terms of economic events is going to come up at 2 p.m. this afternoon. That's when the Federal Reserve's Open Market Committee announces their decision on a rate hike. The change has been phenomenal over the last week or so. 7-8 days ago today, we were saying nobody expected anything other than a 0.5% interest rate jump. Then over the last week or so, especially with Friday and yesterday's inflation numbers, the producer prices yesterday and the consumer prices on Friday, now it's almost becoming conventional wisdom that we're going to look at a 0.75% rate hike this afternoon. Now, that's going to affect a lot of things, among other things, credit cards, mortgages, the federal bond rate when the federal government starts renewing bonds as they expire because the yield is generally expected to match what the current prevailing rate is. This could be a seismic effect if they go up 0.75%, and heaven forbid they do more than that.
Well, that's right. If they go up 3/4 or more, or if they go more than a half, it'll be the biggest rate hike in 28 years that we've seen. So, I was reading Jeremy Segal, which is he's one of the professors at the Wharton School of Business, and he says what needs to happen if the Fed really wants to curb inflation is they need to do a 1% rate hike right now.
Oh, that'll curb inflation, all right. It'll also throw us into a depression.
So I
I have
think,
always said I've always said the reputation of our Federal Reserve among other central banks around the world, and I cut them slack because this economy is a flipping battleship. It's so big, it's darned hard to control. But we're not known for having a Federal Reserve that responds proportionally to economic stimuli. We either overdo it or we underdo it. And in the case of cutting things back a little bit, overdoing it sometimes throws us into a recession. And our Federal Reserve does not have a historically good track record in terms of reading the measure necessary in order to keep us on an even keel. So I'll admit to being a little cynical.
well, that's true. And I mean, I've seen several op-eds that and some economists coming out and feel like that it is still somewhat a possibility that we could get a 1% increase today. It's not many people that are saying that, but there is a slim few in there that think that that is what we'll get this afternoon. And so whether or not we do, if we get 3/4, I mean, that'll be a huge increase to everybody in terms of what the cost of doing business is going to be.
Do you think that the declines we've had over the last week have sufficiently baked in a 0.75% rate increase this afternoon to the point where we won't have a seismograph in the charts if we get 3/4, or do we have to bake in a little bit more in order to make it not an earth-shaking event?
I mean, one of the things that I did read was that it's kind of baking it in, that's kind of the anticipation with the numbers that everybody's seeing, is that we're still still pretty hot when it comes to inflation. And so there seems to be, maybe that's what's happened in the markets this last week or so, is that there is that indication that we could see that 0.75% increase. And the possibility is that we've seen that baked into the numbers now. That's why we've seen the decline that we've seen this last week and a half. And so, but you know what? Nobody knows, right? There's no crystal ball out there that says this is what's going to happen. We have to live it. And once it happens, we'll see how the markets react, how the traders react, and what happens going forward. The issue is just being prepared.
I was kind of thinking that this decline over the last week or so pretty much started on the day that the Wall Street Journal said they were expecting a 0.75% increase being likely. That was when the decline hit. The question, I guess, becomes whether or not we sufficiently baked that in to adjust the projected earnings per shares that we'll get with higher borrowing rates. It'll be intriguing. If it's baked in, then we get a 0.75% rate. There'll be the usual jitters, and then things will continue where they were going. If it's a 0.5%, we'll probably skyrocket for the second half of the afternoon hours. And if they do a 1% hike, well, you and I are going to be playing a funeral dirge tomorrow morning as to what happens.
Well, that's right. I mean, we'll continue to have to just monitor. But I mean, I've seen that possibility, but I'm seeing the futures just going gangbusters this morning.
Yeah, that's kind of interesting this morning. Evidently, either it's a dead cat bounce, we're reshuffling and finding issues that are undervalued, or something going on.
Well, I'll tell you, Dave, we're starting to see, and I don't have any reports today, that no company's reporting today, but here's the other thing. I'm starting to see little tidbits, now not a lot, but a little article here, a little article there, from some economists that really indicates that there are some people that believe that we're getting really close to a bottom. I mean, we're obviously, the NASDAQ's down, I don't know where it is exactly now, but somewhere in the 35 to 40% range. We've got the S&P 500 definitely below 20. It's in the bear market territory right now. The only one that's not there really right now is the Dow, and I'm sure it's getting close. I haven't ran the numbers on it lately, but it was far enough away that I don't think we're there yet. And maybe that's the last shoe that has to drop before we get a rebound. But nobody has a crystal ball, and that's why it's so important that folks that are so close to retirement make sure that they don't have too much risk in their portfolio, because if this thing bottoms out, it could hang around there for a while before it starts to move back up. And so you don't want to get caught in a bear market or down market if you're really close to retirement, because that can hamper your cash flow when you get ready to retire.
Absolutely. And the alternative advice for folks in their early 40s that might have 20 years left before they retire, if you got some spare cash, this is a buying opportunity. You might not hit the bottom of the dip, but you're definitely going to see some growth potential between now and the next 20 years from now. The advice differs depending upon age and station in life, doesn't it?
It absolutely does. It really does.
Absolutely. Resetting the table for the morning. Off day on the Dow, off day on the S&P yesterday. I'm sorry, I'm just calling it flat. A minor up day on the NASDAQ yesterday. 45 minutes before the open. What are we looking at this morning, sir?
So right now, well, like I said, we got some nice looking green ink. I mean, I can't remember last time we saw green ink starting out the day like this. It's been that long. We got the Dow up 0.8%. We got the S&P 500 up 1.1%, and we got the NASDAQ 100 up almost 1.5%. So, and then you throw in the Russell 2000 up, getting close to 1% as well. So some good looking numbers, man, if we can just follow through. But the follow through, I'm sure, is going to depend upon what happens at 2:00 today when Chairman Powell comes out with that interest rate announcement.
The market is going to open at 2 this afternoon, basically,
yeah,
I
exactly.
suspect. Yeah.
And so we've got silver up. Man, it's making a huge jump today, Dave, up 3.1%. Gold's up 1.25%. So nice moves there. We do have crude oil down about 0.1% at $118.78 a barrel right now.
All right. Asian rim markets were mixed at the close early this morning. Europe is showing a rebound based on our futures. They're all up basically around the 1% range halfway through their day. Getting that stability and getting a plan based on your station in life varies depending upon where you're at and what your investments are at. That takes an extra pair of eyes. Where do I find your expert eyes, Phillip?
Devin, give us a call at 863-382-0037. We've created our core retirement design so we can help you design the retirement you always dreamed of. To schedule your 30-minute, no obligation phone consultation, just give us a call, 863-382-0037. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and 95.3 FM.
And back here tomorrow morning, same time. Phillip, thank you so much. You have a good day.
All right, buddy. You too.
Thank you. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. I know it's been rocking and rolling and ups and downs and topsy-turvies on the market, but that's why we developed the core retirement design. Give us a call. Let's walk through a 30-minute phone consultation where we can make sure you're on the right track to the retirement you always dreamed of. You can give us a call, 863-382-0037. Until tomorrow, have a great day.